All right. Good morning, everybody. We are risk on, green on the screen around the world. Japan did not change the system. They didn't blow anything up. And so the markets are trying to digest that a little bit. Right before I started streaming, there was a significant move in the market. I looked around, I couldn't find yet what the issue is. But Japan is up the most this morning, probably a sigh of relief more than anything else, followed by the Russell 2000 is kind of that broader market backdrop that we continue to talk about, and expecting more than the Mag 7 to do all the work. Although yesterday it was the Mag 7 doing all the work. Followed behind that, we got the Dow and then the S&P and then the NASDAQ last, with Hong Kong sitting in the negative, not quite at 0.5%, but close enough. So we're still not seeing that shadow stimulus, and the China ADRs are expected to continue to languish at this point. It's all about housing this week, and we get more of that data today. And then we have Fed speakers, one in the morning and one in the afternoon. They're just going to try to continue to expand on that dot plot that we got last week, kind of reiterate what Powell talked about. They are all trying to sing from the same hymn book while also trying to sound as if they have their own voice. It's a hard row to hoe, really, when you think about it. But one of their mandates that they've been continuing to work on is better messaging and trying to carry the narrative collectively. We'll see if they can manage to do that. There was some news on the metal and aluminum tariffs that were put into place during the Trump administration on Europe. There could be a new trade agreement tie in really nice with, that kind of sympathy move from ex-steel yesterday that we saw running through other places like Nucor, and just the entire space lit up. Could see more of that as a follow through. It's an interesting way to say it. They said the Bank of Japan disappointed markets, as if we want them to blow up that last bastion of negative interest. Maybe they do. All right, this should be Canada CPI. Let's see. Either way, it's not ours. Yeah, there it is, Bank of Canada. So we'll get Bank of Canada's CPI this morning, get through these housing starts, housing numbers. We do have additional auctions at 11 o'clock. So as always, watch the clock. I know it's not as fancy as some of those other tools out there, bells and whistles and lights and all that good stuff, but the clock can make you a ton of money. We have a missed daily pivot so far. This is nice to see after we got tangled up in our daily pivots the last 2 days, kind of implying that we were in a topping pattern and that we might roll over. I did mention yesterday to be cautious, be careful that this topping pattern didn't have necessarily all of the signals in it that made me believe it was going to be a topping pattern, and that we could be basing before legging up into a new zone, which we did yesterday afternoon. This isn't I told you so. This is the idea that, go back and look at it yesterday. Try to identify as many characteristics as you can that help distinguish that from a true topping pattern where we would have rolled over and started heading back down the other direction. With the MDP that we have so far, it doesn't count until tomorrow, but so far we have it. That kind of implies that we're on the move again to the upside. These are other examples of those MDPs. If you want to know more about that, just hit YouTube and search Mystic Daily Pivots. You'll certainly find it. I don't trade the strategy, just to be clear. I only use it for analysis, but that's the way it goes with a lot of strategies, right? They're not necessarily something I want to trade, but they are fantastic to kind of gauge what's going on in the market. Speaking lately of volumes, this is a daily chart on the right. And you can see when the contract changed, obviously, and we got into the new contract for March. And of course, we expect, normalized volume. And we look left, we can see that we're kind of in the same volume regime of where we've been before. That makes sense. But you can see over the last few days that depreciation in volume as well, right? Almost a 50% reduction, not even almost. I would say that is a 50% reduction from the volume we had on the 14th compared to the volume we had on the 18th. Now, obviously, today's volume, right, is minuscule. We just started, but the volumes are off a little bit. The open interest is a bit low, but, after a contract change, we generally start off a little low and build back up from there. So we've got to let that play out a little bit. So we had IX10, and then we broke out with that wick move and failed to keep it. So we continued IX10. Now we're broke out, but we're still inside of yesterday's range, still inside of that wick structure. Kind of sets us up pretty nice, though, really, if you're looking for a play. If we break back down below yesterday's close, got a nice short setup. If we break out of yesterday's high, then you've got a nice long setup. It shows that we wicked out, but it was a part of this move that we experienced right before I started streaming, where I said I didn't see the catalyst for that yet. On the ES, it doesn't look as frantic, but if you were watching the NASDAQ, it was a much seemed like a much more significant pop, right? But of course, it was just a pop and drop. And we're moving right back down into that VWAP. We're still a long way from the moving averages. We're flirting with that round number, 4,800. And we've got the ADR half at 4,809. We're much closer to the upper ADR line than we are to the bottom or the lower ADR line. But to get there, we're going to have to break back down inside the previous week's levels because we're inside week breakout. Then we would have to get through our own Globex low and then that daily pivot point, yesterday's open, yesterday's RTH low. Then we can get down to that ADR half. So we have a lot of pivots to the downside we'd have to concern ourselves with. One thing I don't like when I'm looking around and I see a big gap or a big hole like this, I don't like it. I want to fill it up with something. I want to put something in there so that, I have some structure, right? Because unless it's an event where we're expected to just drop through that zone relatively quick, then we're going to pause along the way, right? We're going to do a little dance. So fill it up, put in some pivot points. One of those pivots would be the RTH open of yesterday. Gives us a little structure. If it wasn't so close, I would also put in, RTH low. Those are a little tight. We've got a drop base rally zone down here. So proximal line and distal line. Now we've got a little bit more structure down there. What we also could do is measure our own Globex. Now, this is a little tricky because of this wick. Technically, that counts. We want to use it. But before we just blindly use it, we want to see where our lines line up. This is a perfect example of that age-old question. Should I use wicks? Or should I not use wicks, right? We've all been there. What if it's a parabolic wick, one of those crazy wild wicks, almost like a dark pool print? Should I still use it? Well, I don't use the dark pool, big, crazy, wild print wicks, but I do want to use this one. And I know I want to use it because look at where the 200 is. That'd be this number way down here. When I line up on that wick, it puts my measured move right on the ADR. And like I've said before, you'll know when you're doing your analysis correctly because it'll line up with other analysis, right? Your lines won't end up in the middle of nowhere in places they don't belong. If you're doing it right, everything syncs itself up. So it's kind of a self-check. Should I use the wick? Yes. It lined up with the 150, pretty decent, not perfect, but it lined up on the 100, well, the 200 perfectly. So now we've got confirmation of those levels that I already had marked out, the RTH low and the ADR half. You love it when a plan comes together, right? Since we are this close to the ADR to the upside, it's hard to believe that we won't go there, especially with whatever catalyst shot us up like that real quick. We certainly do have low enough volume that it wouldn't take too much to move us in that direction. Continue to focus on this CVI, Cumulative Volume Index. I posted this in the Thinkorswim workbook with a little bit of background. You don't need my specialized one. The CVI that's inside this, I didn't change that. So if you use the one that is on your broker or the one that is in Thinkorswim, you can't use the initials. You got to just type it out. Cumulative Volume Index. So if you didn't want to use, the one that I made, you can certainly use that. And on most, say like, I don't know, Fidelity, TradingView, you're going to find Cumulative Volume Index. The only difference between mine and the original is I added the Bollinger Bands around it, and I added a couple of moving averages. Generically speaking, you want to be long when the CVI is above the 10-period moving average. Pretty simple, right? It's basically what we would do in a market. And then you want to look for divergence, and divergence is why I keep bringing this up. So you can see this significant move to the downside, bringing us back in to the Bollinger. Being outside of the Bollinger was an awesome example of an acceleration. But we continue to see price grind to the upside. And the CVI pulled back sharply and is now flatlined. So we've got a discrepancy there. We've got divergence, kind of needs to be resolved. And all that's really stressing is to approach with caution, right? I'm not saying, sit out, just maybe reduce position size a little bit, take profits a little sooner. In the grand scheme of things on the weekly, we're still trying to turn things around. We've got a long way to go. $10-day, 30-minute volume profile. We've got a classic B shape at this point. We do have these bit of a wedge forming, and this sort of wedge generally breaks to the downside, but what we could get, what we've seen before, is you'll get a wedge like this, and you'll get a fake breakout to the upside first, and then the true breakout to the downside afterwards. One of the things that I want to stress caution with this is that the wedge has gone on too far. We're supposed to end the wedge before it completes getting all the way to the apex, right? Just kind of think about how the shape of this thing, if this is that wedge, we're supposed to break out of this long before we get all the way to the very end. And if we do the fake breakout, then we would start with something like that, and then we'd cut through like that. Well, if you throw your lines on this, price has come up all the way into this, the very tip of that wedge, and it's not supposed to do that, which invalidates, in my mind, that wedge completely. It just takes it off the table. And you might find that unusual, but there's randomness in the market, and you might see patterns that don't necessarily belong or that don't exist. Humans are great at that. We see patterns even when there are no patterns. So this could just be, more of a random wedge than anything else, and it's not a valid price pattern. There's precedent behind this approach. We're going to mark it out, and I'm going to keep it as a wedge either way. But I'm just throwing that out there. It has gone on too long. It should not have reached this deep into that wedge, into that apex. $47.50 is our line in the sand for structure. If we break that, it's a deep, shallow, a deep cut or a shallow volume zone. We would likely fall through it very fast, just like we climbed through it very fast back here. I mentioned yesterday that the point of control would be up into our area likely by Wednesday. And we were building that structure out really nice yesterday until we had the breakout. Now we've left that 47.70 area behind, and the point of control won't move up if we're continuing to grind farther away from any structural area, because it keeps the volume really low, right? So if we retrace today back down into that 47.70 area, I expect that we'll magnetize there, be drawn to it like COG, center of gravity. It doesn't line up on a gravity point, 11, 32, 92, but that's what I would expect if we come back into that 70 area, is that we'll stick it and bring that point of control up. We've already got the point of control from TPO at that same zone. Looks like we want to retest that breakout. Awesome. No new point of control. Yesterday's POC has already been taken out multiple times. There's nothing to carry forward unless you want the value area high. The textbooks will tell you to carry forward the value area low. high and a point of control, whether or not they've been hit at all. I've got enough pivots, I don't need another one. And they usually line up with things like yesterday's low, yesterday's high, something like that. So I don't need it, but if you are lacking pivot points, then you could always do that. We're still inside our weekly range so far. Things are looking at reasonably decent. We took half that range yesterday. If we think about the starting point and the top side, we traveled half that distance. And now we're focused on trying to expand beyond this IX10. I don't know what to do with that pattern. We're getting close to 5% above the 10-week moving average. We've been higher than this before, but it's not very common. And this does fit being overbought. We really expect a stall here while the moving average comes closer to us. There is a great distinction between moving price back towards the 10 or holding the line and letting the 10 come to us. So we don't have to fall to resolve this overbought scenario. We just have to hold the line. There's a phrase, a correction in time, not a correction in price. It's an interesting phrase. If you want to research that, you'll find research on it, amazingly enough. A lot of the phrases that are used in the market have books, webinars, or history attached to it. And that phrase has a lot of context behind it. Just wanted to take a second to point out the NY Fang. And I know a lot of us use modified Mag 7 homegrown little chart formulas with Apple, Microsoft, Google, right? And we use weighted numbers in there, different values, different weights. But you can use something like the NY Fang, which, all you got to do is punch in the symbol. And there's no doubt or confusion about the weights within it because you just use it, right? However it exists. The various weighted Mag 7 charts that are out there, we've been waiting for this breakout, this all-time high kind of breakout. And on the Mag 7, we'll have to look at it this morning, but as we started the week this week, we weren't outside of it. But on the NY Fang, we got outside of it last week. So here's one of those modified Mag 7 charts. And you can see, sure, this week, yesterday, as a matter of fact, we started that breakout. And of course, we also kind of gave quite a bit of it back. So as much as it is, neat and cool and interesting to isolate just the Mag 7 and put them in their own chart and add these various weights to it, at the end of the day, this was the missing piece of information. There's our breakout. This is something that a lot of analysts have been waiting for, and they've been calling it the old 1999 remix, right? Like back in the day right before the market really exploded into this frenzied runaway massive move. And of course, you can always just set your charts to be able to go back to 1999. Probably something like stockcharts.com, something with an older chart to let you look back then if you're limited. But it was a fantastic year, right? It was like this just massive, everything ran kind of thing. And it started with tech. There are a lot of reasons to be concerned. And there's always bricks in the wall of worry that it's going to tell you, shouldn't be long or be cautious or, look for shorts, that we're this close to crashing. And then we just keep grinding higher and higher and higher and higher and higher. So that's why bringing in something like this CVI as just a generic representation of breadth. As long as we're above that 10, the market's just going to continue to run to the upside. And maybe not run, but we're not crashing. So we got nat gas down 2%. Behind that, the VIX. And that is all of the downside. For the upside, we got Bitcoin 2.5%, bonds, which is likely due to the Japan news, and financials. You can see the significant move in the NY Fang yesterday. I mean, that was just such a monster rally. But it's worth pointing out down here, this is cumulative tick. And you can see that we were in distribution really early in the day, and we stayed there all day. I mean, it got pretty negative out there, -4, while the fangs continued to rip to the upside. So this is that divergence we're going to be dealing with into the end of the year. We're going to have all sorts of just crazy signals coming out of these different breadth tools. And if the Mag 7 by themselves is doing all the heavy lifting, then you can see, 90%, 80% of the entire marketplace down and still see the indexes sideways to up because the fangs are carrying them. That's crazy stuff. It really messes with our tools. Breadth did start to pick up on the NASDAQ after about 11 o'clock. And it really expanded nicely to the upside. Same thing with the S&P after about 11 o'clock. We kind of picked it back up again. I was reading in Spot Gamma how the options flow yesterday went really bullish on things like Meta, Tesla, NVIDIA, and then at different times on Microsoft too. The options turned from bullish to bearish just like at the flip of a script and went the opposite direction. They marked highs on that day, on yesterday, in things like Microsoft's high, Tesla's high early in the day. The flows didn't follow through for the rest of the day, right? Crazy bullish call volume with puts being sold, and then it just flipped. So it's going to get a little wild out there using all these different tools. That's kind of the point, right, of bringing it up. So here's the SPY yesterday for an example. The red line, oddly enough, is lined up pretty close to where we opened yesterday. So, I mean, it's not perfect, but it'll help for the visual. And then we've got VWAP in there. So the S&P opened above VWAP or opened and jumped above VWAP, held that through most of the day and expanded from 471 to 473 before giving anything back. The weighted AD was just a choppy, nasty mess through most of the morning, got cleaned up around 11 when we crossed back above VWAP here, and it stayed good. But usually the weighted AD in a bullish market's going to get above 250 and start pressing into 500s. We couldn't even get to 200 yesterday. And then you can see where that cyan line really kind of gave it up and started dumping. And the histogram bars basically just held that high of the day and stayed there until the end when it came back down. But we started losing breath at 12:30 back here when it topped out, kind of giving us that clue that, hey, that's it. We're not going to get any more out of it. Of course, you couldn't tell that early. You could only tell later as the cyan line had gotten deep enough in there that, yep, there wasn't anything left to this push. But the ticks stayed mostly in the red, and we were crisscrossing back and forth. No value, no help, no 750 push to the upside or the downside with a negative 750. There just wasn't anything there. So people were asking yesterday, hey, is this going to be considered a trend day? And the answer was no. There was no trend. It just kept grinding higher and higher and higher. So, keep in mind, we can't always put labels on it, right? We can't call it a trend day, can't call it a rally, but we had to call it something because it just kept going. Okay, so we grinded higher, but these signals are going to continue to let us down or only be useful in the look back when usually they're more prescient than that, and they offer us clues for opportunities, before they're even fully formed. Got to take what we can get. So just approach with caution, right? The best tool right now that is still functioning correctly is price. So if you're trading, one of the communications names, then look at other communication names. If you're trading semiconductors, look at other semiconductors. IWM continues to expand this morning. It's looking pretty good. Oh yeah, that looks much, much better compared to the NASDAQ chart and the ES chart. So we got IWM with an inside day breakout, struggling to keep it really steep advance here in the last 20 minutes or so. I'd be a little concerned with how fast that moved. It almost looks like a liquidity gap. So approach with a little bit of caution, but we have hit the ADR half, so target met. If that is the end of it and we start heading to the downside, when you hit an ADR this early in the morning to one side, it offers the opportunity to go ahead and hit the other side. That'd be 1986 to the downside here after we cut through the daily pivot point. So kind of lay these structures out to the downside level by level, just like we mentioned earlier. I don't like, big empty spaces on my chart. I want to fill them up with pivot points. So if we look to the downside here, what do we got? Well, one of the things that we can do is just measure that move. So 2018 is the 50% mark. Get past that, get back to where we started, which will get us through VWAP and the high of yesterday. Get through the daily pivot. Then the close of yesterday, the Globex low. And it looks like we can add to that the Globex low of yesterday. That'll fill in a pivot point, a gap down here. Oops, that's the wrong spot. That's a drop-based rally zone where we could add a proximal line even if we wanted to, but we don't really need it. And then the low of yesterday and the Globex low so close together that they're basically one zone. But I wouldn't short this on faith, right? Got to let it actually provide some sort of reversal topping pattern, something, before I'd give that a shot. A little bit of precious metals, silver, bonds. Jets are continuing to work on that 200 period daily moving average. Looks like we could get red to green, which is the R2G trade strategy. I don't know if you guys have, it's not an old one for sure. Let's just take a bunch of this stuff off. So R2G, it's been around. We closed at $19. We're gapped up this morning to $19.15, which puts us right about there. And that's an R2G, right? We went from red yesterday to green today. Think about how it recovered yesterday. So closed here, dropped down, opened, dropped down, but rallied back up, closed here, and now we're sitting here this morning. It didn't get the gap closed down here, which is a little concerning. But I like this kind of pin bar reversal. Usually I try to catch those near the end of the day, go long in a call on that day, so that if it didn't work today, then I can shut it down, pretty early in the morning. And I got it on the day that we were still red. Usually you get a better price in your calls if we're still falling, right? You can still get a decent price on your calls later in the day on that red day than you can this morning after we've already gapped up and those calls start to get expensive. It's not too late though. What I would expect on a setup like this is what I would hope anyways, is as we come into the open, maybe we fade down and bounce off of yesterday's open, gives us a little bit of a test of support, and then continue the rally to the upside, taking out this doji from last week, the 15th, and then challenging this high. It's all a part of this continuation in jets. And it's been a reasonably decent move. You just got to keep your eye on crude, right? Because the oil yesterday had that pop to the upside. And even though it was a red day, it was still a pop to the upside. You can see how it's a full green candle showing that we opened higher than the previous day's close, and we closed higher than the previous day's close, but we closed lower than where we opened. So if we continue to sell off, and that's what it looks like, we closed at 68.09, we're already at 67.80. If we continue to see oil sell off, we could continue to see this move up in jets. And this would just be considered a nice pullback along that move, right? So far, I mean, that's looking really good. So there we go. It's written out in plain English. Price is above the 8 EMA, but closed lower than yesterday, which implies price trend is bullish, but improvement is slowing. Yeah. Kind of cleans it up really nice. No, they won't roll the call wall up until there's, I mean, you won't see it rolled up until there's activity that rolls it, right? It's not like moving a peg on the pegboard. It will be rolled up when the optionality shows that there's a new place, right? We will find it at a new level when the numbers are there. I was just scrolling through here, and 10 days out, we've got the 17,000 level for the NASDAQ on the call side. And that's the only thing there. I mean, there's nothing else anywhere around. And that level may be too far out in time still. And in front of it, there really just is, there's nothing. So we won't see that call wall line move until we see options that give us that. Now, notice today, the open interest here is going to be gone, right? Because these are going to expire. They'll expire today. Tomorrow, what do we got? Mostly single digit, a couple of double digits. 1,700 is the highest one 2 days out. It was also the highest one now. So it'll recenter when they go in and trade, right? And once they trade enough, then we'll recenter. And when we do, it's going to be that 1,700. All right, so Jets has stayed above the 3 MA. Keep the 10 as your line in the sand. That's 1850. And I would continue to press long plays in this. I don't know if I would threaten 2250, but 21 and even 21 and a half wouldn't be that bad, right? That's well within range. Yeah, you've got your pullback, which is what everybody says they want, right? Buy low, sell high, catch a trend in a pullback. And yet usually what I find is when we actually have price in a trend and it's now pulling back, then everybody's trying to short the darn thing. Now, from a swing trade perspective, especially if you're using stock, then you could try to defend the trade even just right out of the gate as you're getting into it. Buying shares at around $19 or so on average, and then buying something like a 20 or a 20 half put, right? It doesn't have to be extreme. You're looking at 80 cents or so. So if you spend money for the 19 and a half put and you bought stock at 19 combined, you'd have an average share price of 1983. We're already talking about seeing shares get somewhere around 21 and a half, 21. So, you could get close to $1 per share. Got to have 100 shares to do what we're discussing here. And then you could consider, well, what would your max loss be? Well, if you have a 19 average stock price and you bought the 1950 put, you can exercise that put at 1950, sell your stock at 1950. So if we fall, if this isn't just a pullback and we just tank from here, you could still sell those shares for 1950 a piece. You bought that put for 80 something cents. So 1983 minus 1950, you're looking at $33 risk. $33 risk. That's not bad. That's per share, so you need 100 of them. It's $330. That's absolute risk other than commissions. And of course, you could always just buy a call, right? Don't even need to mess with the shares if you didn't want to. I don't like these screwy numbers that are in here. It's usually what happens when there's some sort of a rebalance or something like that. And this is an ETF, so it was most likely some form of rebalance that gave us these odd numbered strikes. I tend to leave those alone, but if you look, they have a lot of the open interest. So maybe that's what we would have to use. I just don't like it. It's a little weird. But the bid-ask spread isn't too horrible. A couple pennies near the open, at the money. And if we could get away with it, I would just come in a little bit. If I'm going to do calls, I would get out of that monthly, which had those screwy strikes, and I would trade something like this Jan 5, 17 days to expiration. It's got, some open interest, a 2-penny spread and 50-cent wide strikes. We can't go wrong there. We continue to see an issue with precious metals versus gold miners, right? The miners are doing, reasonably well. Silver's up, but we're not seeing that same kind of love in gold itself. We see emerging markets are trying to come up a little bit. We got KWEB up to 30%. Or yeah. Yeah. See if we could get a little stability here on that trend line. It is a little concerning with the MACD. We got primary and secondary trend is bearish, and we're below the 0 line. So, this isn't a swing here. This is more of just maybe a bullish day, if we can get a little pop up. Otherwise, this is going to turn into a bounce off of support with a rally into resistance before rolling over and continuing to the downside. Everybody, be careful, be safe. See y'all tomorrow.